Welcome back. In this lecture, we go over the cash flow statement. First, let's talk about the interlinking between the cash flow statement and the other statements. Let's look at each item in detail. The beginning cash balance is taken from this is being pulled from the income statement, but it could have this apart from the beginning cash balance, every other thing is taken from the balance sheet and the income statement. So this value comes from the input sheet. So we had taken put it at $100,000, so that has come on, that is reflecting here on the monthly in the monthly cash flows. So if you want to minimize this, just click 1 again. If you want to expand, click 2, 1, or you can click plus for expanding it for each year. I didn't mention this in the balance sheet, but you probably remember from the income statement lecture as well. All right, so the beginning cash balance is coming from the input sheet for the first year, and for the second year, this is just the this equals the closing balance. Now, net profit is something which we are getting from the uh, income statement. So the net profit of the income statement is brought into the cash flow statement. Adjustments are made for any non-cash items on the cash flow statement. Why is that important? Well, obviously we are trying to understand what is the cash that is generated by a company. Now, for accrual basis of accounting, as you may recollect, we have depreciation being charged on an annual basis over the useful life of an asset, rather than being charged at the beginning itself. So the impact is such that the cash is actually paid initially. So in the cash flow statement, we would see an impact on the purchase, but in the case of uh, depreciation, we are going to see the impact on an annual basis. So that's why this is also known as a timing difference. And the impact is now such that to show the actual, to reflect the actual cash, we need to add back this expense of depreciation to the net profit. Now, on this model, we'll not be showing the purchase as an outflow, because this was considered as something which was invested in the company at the beginning. If you have purchases in the later years, that will show as a payout. All right. Okay. So right here we have depreciation, we have net profit before depreciation, and then we have something called changes in working capital. So we already know what working capital comprises of. That's current assets and current liabilities. And in our case, it's accounts receivable, inventory, and accounts payable. Now, if you want to understand cash flow statement, I would suggest you can check articles out on Investopedia to help you understand why certain items show as negative and certain items show as positive. It will go a bit beyond the scope of this lecture, so I'll leave that to you for your research. Now, in terms of how this has been calculated, is this figure of change in accounts receivable has been taken from the balance sheet. So for the first year, there is no other year to compare with. So the balance of the current assets and current liabilities themselves will be reflecting as change. So let's just check that. Accounts receivable is at 3,288 over here, and accounts receivable is at 3,288. Since accounts receivable has increased, cash would have reduced. This is a concept which might be tricky initially. Imagine this: if this were to go to 6,000 and cash is a balancing figure, we would expect cash to go down. So if whenever accounts receivable or any other asset increases, any other current asset increases, cash goes down. And when such an asset decreases, cash goes up. Why? Think of a debtor, or a customer who has not paid you cash. So you deserve to receive that cash from him. So once he does pay you that cash, his accounts receivable amount will go down and your cash balance goes up. So that's how you can understand accounts receivable and inventory. Similarly, in inventory, when inventory gets sold, inventory value goes down, cash goes up. Okay. All right. So Next, in accounts payable, that's the other way around. Higher the accounts payable, higher the cash. The lower the accounts payable, lower the cash. So as you pay out accounts payable, cash also goes out. Thus, we have the increases reflecting in inverse manners. That is, accounts receivable and inventory are showing as negative impact cash flow, and accounts payable increase is showing as positive impact cash flows. Overall, the net impact in changes in working capital comes to this much, $5,096. As you change anything on the input sheet in terms of the cash conversion cycle, you can also notice a change here. So let's say, for example, it takes us 60 days to make collections from customers. What does that do to the cash flows? As you can see, the accounts receivable has gone up because now there are more people who have not paid us money. So that's why this has gone up. I'll change it back to 30 for the example, but you can toy around with this and see how the model reacts. Okay, so we have now arrived at cash flow from operations, which is equal to A plus B, A being net profit before depreciation plus changes in working capital. Then we have cash flow from financing activities. I've not covered this for the lecture, that is payout of borrowings. Then we have net increase or decrease in cash. This again reflects a the impact of cash flow from operations and financing activities to then arrive at closing balance. The closing balance is what we get from adding beginning cash balance to the net increase or decrease in cash during the year. So overall, here you've seen that the impact is directly except for one item, everything else is one from the income statement and the others are from the balance sheet. So that covers cash flows, and I will catch you in the next lecture. Thanks for watching. Bye for now.